Good afternoon and welcome to our webinar today. My name is Debbie Nappi, and myself, along with Susan Reed, are the co-leaders of Saks Healthcare Industry Group. We are very excited about our topic today and to have our guest panelists. This has been an unprecedented time in our history, and today we're going to focus on the effect of COVID on our dental practices and how they have faced the implications and what we can anticipate for the future as the vaccine will be rolled out within the upcoming months. Here is our today's agenda. We're going to speak about the emerging trends in dental service organizations, market trends in dental practice mergers and acquisitions. Then Sue and I are going to follow up with PPP loan forgiveness update, the new legislation for the New Jersey BATE, the New Jersey Business Alternative Income Tax. And then lastly, we're going to speak about the HHS CARES Act Provider Relief Fund reporting requirements. That is definitely a mouthful. Over the past few months, we've had many inquiries over practice valuations, the benefit of joining a dental service organization, remaining independent, preparing a practice for sale during these times. And we have the privilege to have our esteemed panelists, Bill Barrett, the CEO of Mandelbaum Salsburg, and Mike Apalucci from Schein, as well as you see Susan and myself. So I have the pleasure of introducing Bill Barrett. He's the CEO of Mandelbaum Salsburg. He's the chair of the firm's National Dental Law Center, and he is also an author of Buy, Sell, Merge, which takes a revealing look at the world of dental practice purchases, sales, and partnerships. Over the course of his career, Bill has advised hundreds of dentists in practice formations, transitions, sales and purchases, associate buy-ins, and the structuring of dental service organizations. In addition to advising on M&A transactions, Bill serves as outside general counsel to many dental industry clients, advising on contracts, employment laws, retention programs, and agreements, as well as business succession and tax planning. Without further ado, I'd like to welcome Bill Barrett.
Thanks, Debbie. Thank you. And thank you to you and Sue for having me on as one of your panelists today. So as we divide and conquer what's happening in the industry today, my area that I want to touch a bit on is dental service organizations. And it's because we just seem to be getting a lot of questions lately surrounding DSOs. We get asked all the time, whether we think that this is a trend or is it here to stay. We get asked questions about whether or not they're still doing transactions and in the same way that they were before in terms of DSOs making acquisitions. We also get questions about, in light of DSOs, how do we go about preservation of private practice dentistry? And then we have a lot of private practitioners who talk about creating their own DSOs and what are some of the reasons why one might do that. So I'm just going to give a little bit of an overview of kind of what we've been seeing lately throughout the pandemic, and frankly, how those trends started before that. From my perspective, consolidation in the profession of dentistry is something that it's been going on for a number of years, and the intensity of it, I don't see slowing down, frankly. I'll talk a little bit about deals and activity during the pandemic in terms of DSOs, but I think as a launching point, it's trying to understand for our clients, especially those in private practice dentistry, why is this consolidation happening at the intensity level that it is, and what have DSOs figured out, right? And I think that part of it is understanding, or they understand what the consumer wants. And when studies are done and you look at patient base and consumers, what do they want? Well, they love technology, right? State-of-the-art technology, nice, clean facilities. Mm-hmm. They love flexible days, being open most days of the week, flexible hours, being able to come in early or come in late or come in at lunchtime. People like when a practice has specialty available so that they not only can take care of their general dentistry needs, but under one roof they can get specialty work done if necessary. And they frankly like that most reasonably decent insurances are accepted. And if you look at what's happened with DSOs, that's at the heart of what they've accomplished. And of course, understanding economies of scale and centralization of services in order to save money and be able to be more profitable. So when you look at that and you look at that the aging of baby boomers and so forth in the marketplace, you see why DSOs are and consolidation in general. It doesn't just have to be DSOs. It could be multi-practice operators or entrepreneurial private practitioners that are growing their enterprises. But for all these reasons, consolidation is happening, and it's a very active market. Now, we're often getting asked right now, well, what about deals? I hear that there's not as many deals going on. This year for our firm, and we're just one firm of many around the country, we have engaged in more practice transitions as legal representation this year than at any year in my 22-year career of doing this. At one point, when we were around Thanksgiving time, I happened to look at my spreadsheet and count up that between Thanksgiving and the end of the year, we were going to be closing 49 transactions in dental or dental specialty. Now, for just one group of attorneys, from this whole country and all the people that are available out there that could do this kind of work, for us to have 49 deals closing from Thanksgiving to the end of the year tells you about how active the marketplace is. And a lot of deals are happening where clients of ours, some of our older clients or clients that are reaching transition stage, are doing deals with DSOs. Now, it is true in the height of the pandemic, when things first started and where there were closures, the brakes were definitely pumped on transactions. Okay, there's absolutely no question about that. And a lot of the DSOs froze acquisitions at that time while people were trying to figure out what's going to happen, especially during the closure, because think about how much it hurt our individual practitioners, and then think about owning maybe 100 offices that are all closed at the same time, and there's still expenses and rents and employees and so forth. So once we got back and things were reopened, we've seen a lot of activity in the DSO market, and from our perspective, everybody's back, and the acquisitions have started again. And what's happening is they're just changing the way they structure the deals. Like all things in life, they're hedging their risk a little bit. So, one of the attractions, there's many attractions that people have had, but one of the attractions that led people to some DSO sales where sellers were looking to perhaps transition to a DSO was that sometimes the purchase price being offered or paid was substantially more than in deals between two practitioners, and so DSOs are still using 2019 as a base valuation, but they're doing things like holdbacks of purchase price or earnouts, in terms of as part of the purchase price, or requiring doctors to hold a little more equity going forward. So what they've done is they haven't stopped doing deals. To the contrary, there's a lot of deals happening, but they've just kind of hedged their risk a little bit based on some of the unknowns. So, in terms of the deal activity and the DSO deal activity in particular, it's still very, very active. In terms of private practitioner dentistry and the preservation of that, going back to my earlier point, a lot of our clients are in this market are using the DSO model, in essence, trying to beat them at their own game, if you will, and maybe deliver it with a little more elegance and quality, but nonetheless try to basically understand the model. So we've had a lot of clients that have taken advantage of this marketplace for fold-ins, I like to refer to them as. But in essence, if as a private practitioner, if you can create a mothership facility, a centralized facility that has the ability for growth and expansion, you position yourself to be able to be active in the acquisition market and be able to bring in other practices that you can acquire into your location. And, that also not only allows you to expand your base, but potentially add specialties by doing these fold-ins. And, really, when you think about it, it's kind of classic economics, right? If I have one facility that I'm able to expand through acquisition, which is, again, driving a lot of the activity that we see, the rent or the mortgage is still the rent or the mortgage. And, the amount of staff that I need doesn't really materially change, and the utilities do not materially change, and insurance costs do not materially change. But if I add in a couple of $1 million practices into my location, a lot more of that top line revenue is going to hit the bottom line. So again, it's kind of like economics 101, but a lot of our entrepreneurial dentists in this market, there's a lot of opportunities for fold-ins because we're seeing that there are practitioners who have accelerated their timetable for transition based on what's occurred. So kind of in sum, my perspective in terms of the DSO world in general is that consolidation is here to stay. It's not going anywhere. Deals are happening, although there's some different spins or twists or hedging of risk involved. There's still a lot of activity and a lot of good valuations being paid out. And for our clients that are trying to preserve private practice dentistry, using the DSO-like models and understanding fixed overhead and the ability to scale is something that people are engaging in, and a lot of activity is going on in that market. So, right now it's a great time to be an entrepreneurial practitioner, in my view.
Have you seen a decline in the practice valuations in the deals that you are doing, or are they just normalizing the earnings because this is one point in time?
Yeah, so what I'm seeing is a recognition that you can't really rely on 2020 numbers to do any kind of valuation. Mm-hmm. So what I'm seeing is, first of all, I'm seeing that sellers are a little more flexible in the structures that they're willing to accept. Historically, dental practice deals had gotten to a point where, because there was so much financing available and which was very robust, you started to get to a point where, with all the competition for deals, getting sellers to hold back a note or to agree to an earn-out structure where they get additional consideration based on future performance, or in the case of DSOs, getting them to take large pieces of equity, those were challenges. And what I'm seeing in this market now is that sellers are a little more open to alternative deal structures. And on the valuations, really they're being based off of 2019 numbers, but the way that people are hedging their risk is they're looking at, okay, in the months, especially the months of like July, August, September, October, November, what do those months look like compared to those same months in 2019? Has the practice returned to its prior glory? Has it, is it off? And what we're finding in a lot of locations, and we do transactions all over the United States, in most markets, we're finding that our doctors have recovered. In some cases, they're doing better than in those months than they did in 2019. There are exceptions. Right now in Midtown Manhattan in New York City, if you're doing 80% of what you were doing in 2019, you're doing very well. Because there are a lot of great practitioners, really known doctors with tremendous reputations in Manhattan who, and I have many of them as clients who are, doing 70, 75% of 2019 numbers, just because if, like, for example, if you're located in Midtown Manhattan where there's a lot of of corporate business, and that makes up a lot of your patient base. And those, employees of those corporations have gone to, Westchester, the Berkshires, the Hamptons, the Shore, and gone to their secondary homes or just working remotely. A lot of your patients just aren't coming into the city, and it's made it a little harder for those practices to make as fast a recovery. But in most places, talking to my clients, their numbers are pretty much back, especially for those people who, had strong practices to begin with. Their numbers are back.
Okay, and then I'm just going to take one question that came through, and then we'll move on to Mike and then circle back with questions later. Someone asked, what is the range of multiples that you are seeing right now in these transactions?
So on the DSO side of things, obviously, and Mike will be able to add some great color here as well. I look at the term sheets and the transactions that we're closing. So let's say in the last couple of months or so, we've probably represented about a dozen of our clients in sales to DSOs. What I've found is reasonable people can have slightly differing opinions here, so it's not like an exact science. But what I found in my own practice is for a standalone individual practice, even a large one, the multiple is capping out at around 6 times EBITDA. I've had a little bit more. I have a practice trading at about 6.5 right now, and I've got some that are trading around 5, but somewhere in that 5 to 6 for a standalone location is kind of the spread I'm seeing. Now, I've done some larger transactions, like I had a 13 location oral surgery practice on the West Coast that we represented in a transaction that closed this summer, and that multiple was more around 8 times. And that was literally in the midst of wondering whether it was going to be a secondary closure in California or not. This private equity group moved forward and acquired my client and paid out on an 8 times basis. But they did require my client to hold approximately 30% equity on a going forward basis. And there were some other parameters they put in place to kind of hedge their risk, but they did pay an 8 times multiple. So the rule of thumb is larger EBITDA, more locations, bigger multiple, standalone individual practitioner, somewhere give or take in that 6 times range.
Okay, and you know what, I'm going to correct myself. I do have one question that came in a few weeks ago, actually. And when you were speaking about the 30% rollover equity, one of the questions that did come in was, how do you then ensure that there is value remaining in the DSO in the future years? Is there any type of coaching or counseling that you provide, when this transaction is beginning?
Well, look, there's no guarantees as to what the future is going to hold or how these companies are going to do. Obviously, the larger groups, they have regular valuations being done. Their stock is being valued. So I'll make up, or I'll just use an example of one of the larger groups, like take North American Dental Group as an example. They have a dollar amount attached to the value of their stock right now, and there's a lengthy agreement, but in terms of your equity interest that you enter into, and depending on what happens, will these groups, the larger DSOs, you're going to find there's values attached to the interest, and while there's some restrictions on when you can call make a put right to be able to have your interest acquired, or be able to turn the interest into cash, there's always going to be rules and regulations in the agreements surrounding that. There is a value there, and unless it goes down the tubes, which is probably unlikely, there's a value. What you're hoping for is that, you know, they're sold to another larger group, or they do a, you know, they recapitalize, and that there's a liquidity event or a payday, so that that equity piece that you've rolled over actually turns out to be more valuable than the enterprise value piece that you rolled over. And that has played itself out over and over for a lot of these DSOs. With some of the smaller, more startup DSOs, or the ones that are smaller, obviously, while there might be greater upside, there also is greater risk. You know, that's, you know, so you have to be careful. Like I just had a couple of calls in the last couple of weeks with some clients who are being approached by DSOs, and they asked me to get on calls with them to hear the pitch. And they were DSOs I hadn't heard of before, right? And I'm thinking, okay, well, if I haven't heard of them, then, you know, let's do a little digging. And you ask questions and you find out, well, how many deals have you actually closed? Well, we own 4 practices. Okay, well, you know, that's not exactly a lot of practices. Now, it doesn't mean that those deals might not work out to be favorable, but I don't think you want to be the guinea pig as a seller to, you know, unless you have a lot of entrepreneurial risk tolerance. Again, if you are a large practice that gets in on the ground floor with an emerging, growing DSO and it all works out, you might do quite well, but you are definitely taking on a higher risk profile by going that route. Whereas if you sell to a nationally known DSO, you know, with audited financials and you know, they've done multiple valuations on an ongoing basis, you can get a higher degree of comfort there.
Great. Thank you so much, Bill. Okay, now we're going to be moving to Mike Apalucci. Mike joined Henry Schein Professional Practice Transitions in 2012. Prior to joining Henry Schein, Mike had completed 7 years at Bank of America Practice Solutions, where he was one of the original 4 dental practice sales regional managers. And he had a key role in reopening dental relationships in 13 states, including New York. Mike handles New York City, Long Island, Westchesters, and the boroughs, including Orange, Putnam, and Dutchess counties as well. He has been one of the top 6 performers nationally over the 3 past years. In addition, Mike is also a musician, as we've come to find out. So without further ado, we'd like to welcome Mike Apalucci.
Great. Thanks, Deb. And thank you, Debbie and Sue, for, as Bill said, making us a part of the panel. Well, good afternoon, everybody, and thank you for being on our webinar this afternoon. I'm going to do a little bit of a different twist, but kind of goes hand in hand at a different level than what Bill just talked about. We're going to talk about trends that happened probably right now, 2020, going into 2021. We'll give you a little bit too of the spin on some of the trend numbers after COVID came about. So first of all, it continues to be a seller's market out there right now. And I know a lot of people said, oh my gosh, the doom and gloom, we have so many, you know, everybody's going to be putting their practices up and it's going to become a buyer's market, especially after COVID. That has not happened at all, as Bill mentioned from the DSO side. We continue to see the fair market value grow out there right now. And one of the reasons is there's just so many buyers out there and just not enough practices on the market right now. And that is in the whole tri-state area, whether you look Philadelphia up to Jersey, New York, and through Connecticut. So the good news is that the practice numbers have pretty much been stabilized also. So we're seeing practices value be still between 50 and 80% of last year's gross. And that continues to be probably the highest numbers that we've seen over the last 10 years. And again, if you get into some of the other parts of the country, as Bill mentioned, Southern California, actually Northern California now, Northern Virginia, we're seeing even higher multiples. You know, they could be up to 100, 115% of last year's gross. Some other trends, we're seeing specialty practices finally coming back to the market for sale now. For a while, we did not see a lot. Ortho and pedo are very difficult to find right now. One of the reasons being both of those particular specialties generally have a number of associates tied to specific practices. And generally, sellers or owners are really bringing those associates in. So a lot of times, a lot of the orthopedo practices don't get on the market, but we are seeing endo now, perio come back, prosthodontics are also coming back. Market, yeah. What we're also seeing in 2020, and this is kind of a continuation from 2019, is what we call partnering branding. Bill mentioned this beautifully. This is where successful doctors maybe try to buy a second or third practice together. So Mike Apalucci, I own a practice doing very well on Long Island. Bill Barrett owns a practice doing very well in Manhattan, but we went to dental school together. So we'd like to buy a practice together, and we'll be 50-50 partners. And it's amazing how much we're seeing that going on right now. Inevitably, down the road, probably they will become partners at all three practices 50-50, and then brand all three practices. That kind of gives what Bill said, an entry and maybe becoming future DSO providers themselves. Another piece is the practice owners right now, particularly as Bill said, entrepreneurial practice owners are looking to buy their second or their third practice. So anytime a new listing comes up, no matter where it is in New York, we really get a very strong population of doctors looking to buy their second or third practices. We call it now the triangle demographic. So a practice owner may own a practice at the bottom of the triangle, and they also own a second practice at the top. Now they're looking for a practice at the bottom of the triangle because guess what? They live right in the middle. So it gives them a chance to be able to better manage three practices. And again, it kind of gives them a future planning too. If they may, in essence, become future DSO individuals and maybe sell all their practices at one time to a DSO. We're also seeing multi-doctor relationship practices where practices are really taking a little more of a risk and maybe have both general and specialist, one-stop shopping. This has become very popular over the last 5 years, and we're seeing more and more of that happening. And a lot of times partners, a GP, prosthodontist will get together and they will become partners in that particular practice. It's kind of a little risky because from the referral side of it, but it's becoming more and more prevalent as we go into 2021. Okay, Margaret. So here's some additional trends for you as we start to march into 2021. These are really interesting. We just got these updated about 10 days ago. 15% of doctors nationally going into 2020 will now be 70 years of age. That's mind-boggling when you think about it. 40% of doctors nationally will be now ready for transition. So that could be doctors who may be from 59 years old, up to 70 are going to be in that, which means they probably are going to look to sell their practice within the next 2 to 5 years, put them on the market. Now the pandemic, the whole COVID piece has really started. That number might have been 2 years, suddenly might be 1 year, and the 5 year may be 3 year. So we're seeing an escalation now in that whole piece. Higher grossing practices from 2016 to 2019, we started to see a marketing, they hit the market by about 20%. These would be more practices doing 1.5 million gross and up. Whereas also we saw practices grossing probably 400 to a million, about 16%. That's going up recently. It's probably more like 18 to 20 now as well. So we're seeing a lot of the smaller practices start to come on the market, which is a real soft spot right now for a lot of buyers out there. Okay, Mark. The ADP HPI group, which has been doing surveys nationally since COVID started, they've really gotten active. They actually update all their surveys sometimes once a week. So as of November 14th, they asked their doctors nationally, what do you intend to do in the next 6 months? 18% said, I'm going to sell my practice. So now we're kind of jumping into that, 2021 market. 5.3% said, I'm done, I'm filing for bankruptcy, I'm just walking away. Seeing a lot of that, as Bill said, in Manhattan, very small practices, doctors just said, I'm done, I'm out of here. Outright retirement, about 16% of doctors said, I'm ready to retire at this point. Now, that 16% could be jumped up with the 18%. You're probably going to see those doctors want to put their practice on the market as we go into 2021. Affiliating with DSOs, this particular survey said only about 2.4% said that they were talking with DSOs at this point. And then doctors in general said, I'm going to find another profession. I had a doctor this week who called me and said he is seriously ready to retire. He has tremendous hand speed. This doctor, I've known him for a number of years. He's going to go into horticultural and be almost maybe run his own flower shop. So we're seeing all the above boxes checked off as we go forward. Okay, Mark. Okay, so anyway, this is some newer information. As I mentioned, this same group, this ADA HPI group, I just got these slides yesterday. And so I'll just run through them quickly, but it'll give you a semblance of what we're seeing in the market right now. In the recovery and renewal area, 1/3 of dental practices reported business as usual in terms of the patient volume. So if you look at the next bullet, patient volume is about 76% of pre-COVID-19 levels, which again, kind of fits with what Bill said in all the closings that he's had nationally. You're seeing about 76% of the volume is back. That kind of holds true. I work in the New York market, the North Jersey market. That's about accurate for what we're seeing in those marketplace areas. Staffing, according to the latest surveys, 90% of the pre-COVID levels, the staff is back. Now, in the last few weeks, we started to see a little bit of a surge backward. And the reason being, as we see these hotspots breaking out again in COVID throughout the country, obviously, if you look at your staffing, your hygienists, your assistants, a lot of them are being forced now. Their children who are home are going back to virtual schooling again, and they just feel they have to be there. So they're kind of stepping away from the practice, which kind of makes kind of a glut of doctors looking for additional staffing. This 90 number probably is even a little bit lower in the tri-state area. We're probably looking more about 80% of staffing back at this point. How about patient capacity? More than 1/3 of the doctors reported that between 51 and 75% of their patient capacity, their active patient capacity right now, up to about 75%. That's a little higher right now, again, in the tri-state area. It's probably more like 61, 64 to 75% based on the local Henry Schein numbers that we've been looking at. So again, there's room for growth there as we go into 2021. And again, to build on what Bill said, and probably what Sue and Debbie are going to talk about, you're going to see that patients are generally coming back right now. How about financial stability within the practices right now? So DSO facilities that we've been seeing are probably been downsizing more, as Bill said, from the March timeframe up through the summer. Whereas the sole practitioners have been looking to either maybe raise their fee schedules, or they've gone directly to the bank and they've taken PPP loans, or generally have taken line of credit loans just to keep the practice substantial at this point. And some of the future stability pieces, dentists 65 and older, we talked about this, more than 1/3 indicated that they are probably going to consider selling their practices in the future, and about 40% retire. That kind of matches up with the numbers I gave you earlier. And then finally, consumer sentiment, with the vaccine, especially right now, as we actually started the vaccine process, we anticipate, and this is kind of what my director, Tom Snyder, he's part of this group, he's been following this very carefully. he really felt that we were going to see, as we got into the end of the year, we were going to start to see patients come back as we got back into 2021. The only places we're seeing a little bit of a change there, again, is going back to Bill. I keep saying Bill, but that Manhattan market right now, we've seen a much slower step up in that area with patients coming back. But you have to look at, too, the very successful practices in Manhattan. I mean, the very successful prosthodontic practices tend to have higher fee schedules. They tend to have a higher end clientele. They also have a higher end, probably in the age area. Those patients have been a little slow to come back right now. So we're thinking that we're probably, as we get into 2021, and we're hoping, obviously, that we'll start to see that Manhattan market pick up again as those patients tend to come back. So to wrap it up, Margaret could hit the last, some just general conclusions, because you asked about the trends. So far, it's still a seller's market at this point. The buyer market has not jumped in as many experts predicted. We're seeing sharp increases in doctors considering retirement and probably moving to put their practices in the market in the future. Practice valuations are being completed to help doctors, with their future decisions and whether they want to, eventually want to move up their time frames to sell their practices or to make other decisions. So, and then finally, I said no one can really predict what transition trends will change in 2020, 21. We've been saying that all along, and it's been such a wild roller coaster ride. I'm not here to tell you what exactly is going to happen, but we wanted to give you a little bit, at least, of what we're seeing out there right now.
Oh no, that's great, Mike. I really appreciate all the great insights. One thing that would be concerning as a practitioner is to know that in a couple of years, 40% of the practices are going to be in transition. Is there anything you can recommend practices do now to start to stage their practice to really outshine the competition that's sure to be out there when they're ready?
Yeah, that's an awesome question. Thanks, Sue. First of all, I mean, one of the things we always recommend, and probably all of us would probably sitting on the panel right now, is regardless of where you are in your transition practice, you should have your practice valuated, by a certified valuation house. You need to get that number now, especially, and don't be scared off by the fact that, geez, what happened in 2020, our numbers are going to be down, or as Bill said, maybe on the other side of the coin, I'm seeing the same thing. My doctors are generally doing better as we look into October and November numbers than what they did last year. So don't be worried, but get the valuation done. We at Henry Schein, we were doing valuations up through the end of 2019 period. And two reasons for that, and Sue may have wanted me to ask this next, I'm sure. We did it that way because you wanted to look at the practice in 2019 where things were most robust in the practice and kind of push away from the fact that we had to close 90 days or 120 days. So that's why all of our valuations have been coming in. And again, the numbers have been quite good for our doctors in 2019. As far as 2020, realistically, we would have not started to do 2020 valuations until the mid-year of 2020, because we need really 6 to 8 months of numbers that are accurate in order for us to properly value the practice. So for a lot of our doctors who did valuations through 2019, we're taking them there. Now we'll be ready as we go into 2021 to look at the 2020 numbers. I don't know if that answered it, Sue. It was a long way around it, but.
Oh no, that was great. And just any insights as to if you are considering a partner, are there a lot of national DSO types of entities that are coming into our marketplace that our listeners should be aware of?
Well, I think, as Bill said, the DSO market, they took a little hit there in the beginning, obviously, because they have so many practices nationwide. But yeah, they are out there. We are seeing, as Bill again mentioned, DSOs that are smaller based DSOs, so 4 and 5. They may own 5 practices already. Their growth pattern and it depends again on where they're getting their finances, their lending. That has a lot to do with it. But I think there is a lot of that happening where, again, people are getting together, multiple practice owners are getting together and say, hey, let's come together and start looking for practices on our own and doing completely separate from their own practices, what might be called mini DSO type of activity. So they're out there as well. But again, we are seeing doctors everywhere either looking to buy practices or buy their second or third practices, or perhaps buy patient files. So if they're in an area, they can say, look, I'm looking for patient files within 15 miles. I'm on the island, anywhere within that. Right. If any doctors just want to walk away and want to sell patient files, please let us know. So we're seeing a lot of that too. So yeah, the opportunities are there. We have not really took a step back. I think Henry Schein nationally last month, we actually closed over 20 practices, which in this environment, that's a lot. And we're probably going to close 40 in the month of December. So a lot going on for doctors. Shouldn't be too worried about it right now. Other than perhaps the values, would they change in 2021? Possibility that they may come down from what we're seeing right now.
Yeah, Sue, can I piggyback on that a little bit?
Mm-hmm.
On your question on those doctors that are thinking about transitions, I always look at that from a lawyer's perspective, and I always try to troubleshoot, like, what are the things that people need to think about? Things like their lease. Let's say they don't own their building or their practice location and they have a lease. Is the lease signable? Is there enough options to renew so that it's attractive for a future buyer? I look at things like, if they have an associate, do they have good associate contracts with a restrictive covenant so that the practice is protected, because a would-be buyer is going to be concerned about that. Mm-hmm. And do they follow the basic employment laws? Like, for example, are they classifying independent contractors versus employees properly in the world of dentistry? We see all the time people are misclassified as independent contractors. Mm-hmm. These are all the things that a buyer looks at and identifies as problems, the mistakes that could be corrected when you're anticipating an eventual transition. And of course, the biggest one that all of us on this call appreciate is in those years leading up, let's say the year or 2 or 3 leading up to a transition valuations and bank financing and all those things are always going to be based on tax returns. So, being a little less aggressive in how expenses are taken or cash, all things like that, the better those tax returns look, the better opportunity that they're going to have as a seller to have a larger purchase price, whether they're selling to an individual practitioner or to a DSO. It's all going to be based off of the tax return. So,
right.
Bill, thank you. Now we're going to transition over to the SACS part of the presentation. And we just want to give you some highlights, because we're going to be a little short on time, but just some highlights as to the dollars that were provided under the CARES Act and the reporting requirement and what's taking place right now. So Sue is going to take us through some of those updates.
Great, and just for your information, these slides are going to be emailed to you, so don't feel like you have to write down any details. You will get the full slides. So before I jump into the PPP program, we do want to let you know that there are a couple stimulus packages that are before Congress. There's a bill by the House, a bill by the Senate, and 2 that are really gaining some traction are the Bipartisan Emergency COVID Relief Act of 2020. This is what is being put forth by the Gang of 8. And then there's also the Trump or White House bill that is also looking to move forward some stimulus. Just a quick overview, both the White House bill and the Gang of Eight bill look to provide for a PPP 2.0. I certainly know a lot of groups are still struggling with having a decline maybe to 75 to 80% of their patient volume. So there is still hope coming down the pike. The PPP 2.0, we believe, is going to be available to those with under 300 employees, so certainly targeted toward smaller businesses. It's for those who have had a 30% revenue loss in any quarter in 2020. It's also going to be looking to expand forgivable expenses to include things like PPE. It's going to be targeted toward small borrowers and those in underserved communities, as well as helping certain nonprofit organizations. And perhaps one of the things that's most helpful for your employees is an expansion and an extension of the unemployment benefits. The White House bill is very similar, but just to contrast a couple things that are different between plans. The White House plan does not expand the unemployment benefits. It extends but not expands the unemployment benefits. However, it does provide for an individual stimulus payment, which the Gang of Eight bill did not. Now, moving on to some of the PPP loan forgiveness issues. We've finally gotten notice from the IRS, although not good notice, as to how they're viewing the PPP loan and its tax implications. So the first notice the IRS issued stated that expenses associated with the loan proceeds that were forgiven are not deductible for tax purposes. Now, as we've noted here, there is a bipartisan bill, some of the other legislation that's pending, all carry provisions to reverse the decision and essentially allow businesses to deduct the expense. But as we're coming up on the end of the year, this is a very significant item that you need to plan around, because it could mean, you know, having 100,000 worth of taxable income essentially added to your planning for the end of the year. The second notice from the IRS dealt with the issue with the overlapping years with expenses in one year and forgiveness granted in another. We had initially hoped the tax impact would not happen until forgiveness was granted. However, that is not going to be the case. The notice states that if you have reasonable expectation to get the forgiveness, then you don't deduct those expenses in that year one. All right, a few details regarding the PPP loan forgiveness application timing. The deadline for filing the forgiveness application is 10 months from the last date of your covered period. Now, depending upon when you got the loan, there'll be either a 2-year or 5-year amortization for any part of that loan that's not forgiven. Now, one thing you need to keep in mind with the PPP loan is that there may be implications if you have a change in ownership. So for instance, if you are in the process, one of those 49 groups that Bill is working with that are in the process of closing before the end of the year, you need to make sure that either the PPP loan has been fully forgiven, or if it hasn't been forgiven by the time the practice is closing, you may wind up needing to escrow part of the sale proceeds until that forgiveness is actually given. There are also changes expected for documentation and other exceptions that need to be clarified. But I think the most important thing about PPP is make sure you stay in touch with your advisor. As we've seen continually through this process, the rules change frequently, and it's very hard to say at any one specific moment what direction you should be taking. So make sure you stay in touch with your advisor in that regard. And now we also wanted to make sure you were aware of something very important in the state of New Jersey, the New Jersey Business Alternative Income Tax, or BAIT. You know, we all love acronyms, so this is the New Jersey BAIT tax. Confused quite a few people in the beginning, but in early 2020, New Jersey implemented an elective tax on pass-through entities with the purpose of finding a workaround the federal limitation on state and local tax deductions, also known as SALT deductions. Now, to refresh you, this SALT limitation started in the tax year of 2018, which capped individual itemized deductions for real estate taxes and state and local income taxes at $10,000 per year. So a few important notes about the BATE program. First off, it's starting for tax years 1/1/20. It is elective and it does require an annual election. Pass-through entities, including partnerships, multi-member LLCs, and S-Corps are available to make this election. But most importantly, single-member LLCs cannot make the election. So you may want to consider planning around that. There is no penalty for failure to make estimated tax payments during the year of 2020 under this program. But one real important caveat is that you should plan to make the online payment by December 31st, 2020 in order to claim the deduction on your 2020 tax return. This is a table of the taxes owed based on the practice income. You'll see the tax rate starts at 5.68% for the first $250,000, going up to 10.9% once the practice revenues are over $5 million. But I think the best way to understand the significance of the program is just to walk through a quick example. If we have a New Jersey dental practice that has 2020 net income of $1 million, we've got 2 LLC members, each owning a 50% share and reporting $500,000 worth of New Jersey source income. So if the practice elects to participate with the BATE program, the practice will pay $63,087 on behalf of its members. Not only is the member then able to claim the credit for the taxes paid on their individual income tax return, but most importantly, are able to reduce their federal taxable income by this amount. So in our example, if the members are in the highest tax bracket, they would each save approximately $12,000 in federal taxes. We do want to highlight there are a few uncertainties with the program. So again, be sure to work with your advisor to fully understand the implications for your practice. But now I want to turn things over to Debbie, who's going to talk to us about the HHS CARES Act Provider Relief Fund reporting requirements. I practiced.
You did better than I did. Okay, I'm going to try to go through this briefly since I know we're coming up against our hour. But during the month of April, under the CARES Act, dollars were dispersed first to medical practices, whereby money was just deposited into most practices' accounts based on a percentage of Medicare, or you had to be part of Medicare to receive these dollars. Then dental practices were allowed then to come in on phase 2 of these dollars. And then phase 3, which just ended, was for any practice that had not applied or received the funding. They made some new provisions for mental health as well as for practices that started in 2020. So basically, they were trying to make sure that they captured all healthcare providers in this program to provide dollars during COVID, the shutdown, and just to make sure the practices were alleviated of their difficulty. Now that we've received the dollars, now comes the fun part of having to provide reporting for the dollars that were received. Initially, during the year, they had set out certain dates. All of those dates were scrapped. And here are now the requirements going forward. So for providers who received in excess of $10,000 in the aggregate, meaning if you received monies during the year, but then you returned a portion of those dollars and you fall below this $10,000 amount, you are not required, you will not have any reporting requirement. Anyone in excess of the 10,000, the portal for HHS is going to open on January 15th of 2021, and then reporting will be required February 15th of 2021. However, they're also giving us a 6-month extension, and we'll see as we go through the slides, because since, as both Mike and Bill have mentioned, practices have recovered. So initially, they were asking you to report for the months of, I believe, March through May or June, when there was such a decline. And then it appeared that all practices would have met the requirements. Now they've changed that, and now you're actually going to be reporting calendar year 20 over calendar year 2019. So I know for some of the practices that I work with, we're now coming across a situation where they're doing better than they've done before. So there might be an opportunity where they might have to at least try to find other ways to utilize these dollars. So the HHS has now given us until June of 2021. Margaret, you could, okay. So basically, now when we go to the reporting, we have to look at healthcare related expenses attributable to the coronavirus, as well as patient care lost revenues. So I've also in the handouts included a chart that was just updated a few days ago, whereby it gives you a list of what allowable expenses are. Because even if you go on to the HHS website, you have to go through all of the FAQs to finally come to an understanding as to where some of these expenses might pan out. But once again, as it's stated here on this slide, we're now comparing your total 2020 revenue over 2019 to see the lost revenue component. You receive the additional 6 months if you can't make it between these expenses and the revenue. But in that additional 6-month period for January through June of 2021, you're still comparing it to the base year of 2019. And please, if you have any questions, you're going to have our email information at the end. Please email us and we will assist you with this, because it's a little complicated. And one thing that I'll just mention that we are looking for clarification on is you might have a situation where you're a cash basis taxpayer for your tax return, but you're accrual basis taxpayer for your financial statements. And we have still not received clarification that when you report these metrics, which method of accounting are we to be reporting on? So we have a lot of questions that we have called over to the HHS, and we have worked with attorneys to try to have further clarification so we know come February how we are to be reporting these dollars. So you're going to see in the next 3 slides, and I'll go through it quickly, that just based on the level of dollars that you received, these are then the various components of expenses that need to be reported. So here's between 10,000 to 499, right under 500,000. These are your reporting requirements. And then if you go to the next slide, it gets expanded. So I'm not going to have the opportunity to go through all of this, and even in the handout, it explains it further. But basically, if you receive dollars under the PPP loan, FEMA, any other SBA program, you can't double dip. So you can't utilize those expenses for those programs and then use those expenses again for these dollars that you received. So basically, any expense that you've incurred related to COVID, be it hiring bonuses, daycare expenses for your employees, any repairs and maintenance, especially for a dental practice, to have patients to be able to come back in, if it's filtration systems, whatever you have done to get your office ready, PPE equipment, masks, sanitizers, all of that, those are all of your related, COVID-related expenses attributable and would qualify under this program as expenses to be reported. And then here's just a little bit more of a detail of the supplies that qualify. Equipment, if you look on the FAQs, there's a whole listing of, depending on the equipment that you placed in service, can you take the full amount? Do you have to depreciate it? How do you depreciate it? It becomes very detailed. So I've been checking the FAQs weekly, just so Susan and I, can then speak with our clients and try to provide them with an update as to how to make sure they've covered these dollars. Do we need a 6-month extension? And how do we go about reporting it? And for people, any practice that received an addition of $750,000, there is an audit requirement. So you would have to speak to your tax professional or auditor as well, your accounting firm, because you are going to have a requirement. Now, if you already require an audit, it can be part of it, but you need to follow up with them. And I listen weekly to the AICPA town hall meetings just to get an update as to what's taking place with the deductibility of the PPP loan expenses. And they just mentioned last week that since this is a new requirement, if monies in excess of $750,000 were received just under the CARES Act, they're going to provide a 3-month extension for this single audit. Because just like all these other programs that we've been mentioning, this is another burden. It's another requirement in addition to operating your practice. So they're really trying to come up with ways to just make this a little bit more simplified and help you during this process. So here are our email addresses. I know we presented a lot today. So thankful for Bill and Mike and all the information that you provided to us. If you have any questions, please send them out. We will follow up. You have the handouts available to you. And we really want to thank you for being with us today.
Thank you. Thanks.
Thank you.
Thanks, everybody.
Thank you.